To begin, welcome to this guide on saving for a down payment in today's market. In this video, we will transform the anxiety of high prices into a step-by-step plan that prioritizes earning, strategic saving, disciplined investing, and lender readiness. If you already have a substantial nest egg, such as $20,000 or more, you are ahead of the curve. The key now is to grow it wisely while preparing for mortgage approval. Next, we will outline our agenda so you know exactly what's coming. First, let's set the stage. Housing markets can feel intimidating, but the earlier you begin with a structured plan, the more time you give compounding and income growth to work in your favor. Even if prices are high, a consistent plan helps you shorten the timeline to homeownership. While luck is unpredictable, disciplined preparation is fully within your control. Now that we've addressed the urgency, let's walk through the roadmap we'll follow. Next, here is our agenda. We will start by reframing how to grow your funds beyond a basic savings account. Then we will explore account options, including tax-advantaged structures in various countries. After that, we will focus on what lenders actually prioritize, followed by a practical 24-month plan. We will also cover budgeting tactics, housing stability, and a proven credit score blueprint. Finally, we will synthesize the strategy into clear takeaways and actions. Before we proceed, a quick disclaimer. The information provided here is educational and general in nature. It does not consider your personal financial situation. Therefore, you should evaluate the appropriateness of these strategies for your circumstances and consider consulting a licensed financial professional, mortgage advisor, or tax specialist in your country. With that foundation set, let's shift into how to make your money work smarter. Moving forward, your biggest risk is not market volatility. It is letting inflation erode your purchasing power in a basic savings account. The solution is matching investment vehicles to your time horizon. For near-term needs, emphasize liquidity and safety through high-yield savings or short-term government bills. For medium-term goals, consider quality bonds. For longer horizons, broad market index funds offer higher potential returns. Automate contributions, reinvest interest and dividends, and keep the focus on compounding. This approach balances growth and safety on the path to your down payment. Furthermore, leverage country-specific accounts to accelerate growth. In the United States, a Roth IRA may allow up to a $10,000 first-time homebuyer exception on earnings, and a 401k loan is possible but carries employment and repayment risks. In Canada, the First Home Savings Account and the RRSP Homebuyers Plan can combine tax deductibility with tax-free growth and structured withdrawals. In the United Kingdom, the Lifetime ISA adds a government bonus. In Australia, the First Home Supersaver scheme can access concessional contributions. Since rules and limits change, always verify details with a local professional before committing. Next, compare common vehicles by risk, liquidity, tax features, and time horizon. High-yield savings and money markets are low-risk and highly liquid, ideal for near-term needs. Short-term treasuries may deliver better yields with strong liquidity and certain tax advantages in the United States. Certificates of deposit lock funds for a period and may penalize early withdrawals. Broad index funds have higher potential returns, but require longer horizons to smooth volatility. Tax-advantaged accounts such as Roth IRAs in the United States, FHSA and RRSP in Canada, and lifetime ISAs in the United Kingdom can provide meaningful tax benefits when used according to local rules. Now let's discuss lender priorities. Regardless of age, lenders tend to favor applicants with 2 to 3 years of stable, verifiable income. They also evaluate your debt-to-income ratio to ensure the mortgage is affordable within your existing obligations. Your credit history should demonstrate on-time payments, low utilization, and responsible use across a mix of accounts. Keep organized documentation, such as pay stubs, tax returns, and bank statements, to streamline pre-approval and final underwriting. Meanwhile, follow a structured 24-month plan. In months 1 to 3, open your accounts, build a 3 to 6 month emergency fund, and automate transfers on payday. Between months 3 and 12, invest consistently, and focus on increasing your income through raises, promotions, side work, or new skills. From months 6 to 18, monitor and reduce your debt-to-income ratio and optimize your credit score. Finally, in months 18 to 24, secure pre-approval, assemble all documentation, and allow buffer time for a disciplined home search rather than rushing. Additionally, implement a simple weekly and periodic routine. First, define a specific savings target and deadline. Next, automate transfers from each paycheck into appropriate accounts, starting with safe, liquid options and layering additional investments based on your time horizon. Then, amplify earnings through promotions, skill building, or select side work. Lower your debt-to-income ratio by cutting expenses, refinancing where appropriate, and avoiding new large obligations. Maintain excellent credit habits with on-time payments and low utilization. Quarterly, evaluate your progress and rebalance. Annually, test your readiness with a mock pre-approval to identify any gaps. As we transition to budgeting and housing stability, structure your cash flow so savings occur before discretionary spending. Zero-based or the 50-30-20 frameworks can both work if you consistently automate and review. Consider shared living arrangements, at least temporarily, to reduce fixed costs and accelerate savings. Ensure you understand your renter rights related to habitability, safety, and maintenance so you do not waste money or compromise well-being. Finally, track your spending with a simple app and commit to a weekly 5-minute review to stay on course. Now it is quiz time. The question is, which factor do lenders typically weigh most heavily for mortgage approval? Option A, your age. Option B, 2 to 3 years of stable, verifiable income. Option C, the size of your first credit card limit. Option D, how much you have in a basic savings account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, 2 to 3 years of stable, verifiable income. Lenders emphasize the reliability of your earnings, along with your debt-to-income ratio and your credit behavior. Age itself is not a primary factor, and while liquid savings help with reserves, stability of income tends to carry more weight for approval. Continuing with credit optimization, regularly pull your credit reports and dispute any errors. Payment history is paramount, so automate due dates and avoid any late marks. Keep revolving utilization under 30% and ideally under 10% for best results. Maintain a modest but healthy mix of accounts to demonstrate responsible use. Avoid unnecessary hard inquiries in the months leading up to pre-approval to prevent avoidable score dips. Next, align your investments with your timeline using time buckets. For 0 to 2 years, emphasize liquidity and capital preservation, such as high-yield savings or short-term treasuries. For 3 to 5 years, gradually introduce higher return assets like quality bonds and a measured allocation to diversified equities. Beyond 5 years, a larger equity allocation may be appropriate to capture growth, provided you can tolerate volatility. As your purchase date approaches, rebalance towards safety to protect your progress. To clarify the decision, compare rent-ready and buy-ready profiles. A rent-ready person values flexibility and needs lower reserves, making it easier to adapt quickly. The primary focus is growing skills and savings rate. A buy-ready person, on the other hand, has stable income and location, maintains an adequate emergency fund in addition to the down payment and closing costs, exhibits a low debt-to-income ratio and strong credit, and holds documented cash reserves. They also have a pre-approval in hand and a realistic view of total homeownership costs. In summary, begin early and automate contributions to build momentum. Match each dollar to the appropriate time horizon so you balance safety and growth. Leverage tax-advantaged accounts available in your country to accelerate results. Remember, lenders place significant weight on stable income, low debt-to-income ratios, and consistent credit behavior. Finally, personal and housing stability reinforces your overall readiness. As a quick, Markdown-style checklist, set a specific target for your down payment and deadline. Automate transfers to invest before you spend. Build a 3 to 6 month emergency fund prior to taking additional risk. Maintain low credit card utilization and perfect payment history. Each quarter, rebalance your portfolio and confirm that your debt-to-income ratio is trending downward. Around month 18 or later, begin gathering documents and secure pre-approval. To wrap up, success here is about discipline, not luck. Increase your earning power, save before you spend, and invest according to your time horizon. Protect liquidity for near-term needs while pursuing growth for longer-term funds. Demonstrate income stability. Maintain strong credit, and manage your debt-to-income ratio. Follow the 24-month plan and refine it as you go. Up next, we will close with a quick thank you and a call to action. Thank you for watching. If you found this valuable, please like the video, share it with someone who is saving for a home, and subscribe for more practical financial strategies. I would love to hear your target down payment amount and your timeline, so share your plan in the comments. Your questions and experiences can help others on the same journey.